Good morning, this is Mark Boud of Real Estate Economics. Thank you for joining us for our weekly webinar series. Our topic today is the Seattle-Bellevue-Everett, Washington MSA. I'm going to give a brief economic and housing market overview and some forecasts regarding this particular MSA, which includes both King County and Snohomish County. We're doing a bit more work up in Seattle. I'm actually speaking at a conference on December 3rd and anxious to enhance our exposure to that particular market area. Let me actually get right into this and show you some information regarding what the housing cycle looks like in the greater Seattle market area. This is back in October of year 2007, and we took that snapshot to give you an idea as to what a more normal atmosphere looks like in terms of housing transactions in the greater Seattle area. On our map, which is taken directly from our website, each one of the blue dots corresponds with a traditional resale, one owner selling a property, a home to a new owner. The green dots are new home builder closings. The red dots, of which there are very few, are foreclosures, the bank taking back a property. And the orange dots, which there are very few, are the bank selling that foreclosed property to a new owner. The overall composition of transactions back in October of 2007 looked like this, where about 75% of the market was dominated by traditional resales and another 22% was dominated by new home builder closings. That's what it typically looks like. This is what it's looked like though over time. Here's December year 2008. You can see distressed inventory begins to pick up. A lot more foreclosures, some foreclosure sale activity, and the new home builder market is beginning to shrink. Here we are in October of year 2009. Resales have shrunk a little bit as has the new home builder market, and distressed housing continues to grow. Here's October year 2010, the most recent month for which we have more information, where we're having a real foreclosure issue up there. A lot of the banks have held off on foreclosing properties in the Seattle MSA and are beginning to do so in large numbers, and so the foreclosure numbers for the past couple months have risen quite a bit, which is of some concern, especially with regard to distressed inventory that's later to come onto the market as foreclosure sales. That inventory is building. In most other markets it's actually shrinking, I should say, at least in most other coastal markets. Not so in the Seattle area. It's building, and that's a concern. It does reflect a lag of the Seattle market relative to most other markets in the nation. Seattle was far later in coming into the recession, and it's going to be a bit later in terms of pulling out of it as well. And it hasn't been quite as dramatic in terms of the disruption in Seattle, though it's been painful, not nearly as painful as it has been in overbuilt markets such as Phoenix and Las Vegas and parts of California. Here's what the overall price trends have looked like during the past 24 months. Price per square foot has fallen from $243 per square foot in October 2008. Right now it's at $222 per square foot. That's a little bit of a rise from where it was a year ago. That's coincided with a very mild drop in absolute or average price during the past 12 months. The overall average price is now $370,000, down from $376 12 months ago, and down quite a bit from where it was 24 months ago. Here's what the transactions look like by type, single family versus condominium. Both are heading downward during the past 12 months, which is of a concern. It suggests that distress in this market certainly is not over as housing inventory builds in this market area, both in terms of distressed and listings. If you break those transactions out by type, resales have gone down quite a bit during the past 12 months, while foreclosures have actually increased quite a bit during the past 12 months. Again, an indicator that Seattle is lagging behind some of the other markets where we're seeing improvements, some of the other coastal markets. Seattle has more trouble ahead of it, unfortunately, at least for another 6 months, possibly all of next year. Will feel a bit like 2010, part of 2009 did in California. 2011 will feel so in Seattle. In terms of price, sales distribution by price range, this is what it's looked like during the past 24 months, where you can see that the activity in the upper price ranges especially has dropped off. And here's the level of distress as measured by notices of sale in Seattle, as well as foreclosures. Yellow is notices of sale. The red bars are foreclosures. And as you can see, we've had an uptrend in notices of sale. That's of concern because foreclosures have to follow that. In fact, now they are following that. During the past 4 months, there's been a bit of surge of foreclosures, and unfortunately that will continue probably for about another 3 to 6 months, the next couple of quarters in Seattle, as distressed inventory becomes a bit more of a problem there, as it is in many other parts of the nation. Again, coastal parts, a lot of the coastal parts of the nation, we're working through that distressed inventory and seeing, despite the fact that we're still seeing a lot of foreclosure activity, we're selling them off and we're absorbing them effectively. In Seattle, they're actually beginning to build. In terms of how Seattle ranks relative to other markets throughout the country, here's Seattle right here. In terms of it being overbuilt, we think that it's about 4% overbuilt in Seattle. That's very, very high for Seattle, but it's actually below the national average and below most other markets in the nation. It's 14% undervalued. Now that's significant for Seattle, but it's not as undervalued as most other areas of the nation. There are some markets which became grossly undervalued as the prices just fell dramatically after the distress in the financial markets. Las Vegas, for example, is 58% undervalued relative to where its incomes have traditionally supported housing values. To put that in perspective, it costs 12 cents on the income dollar to live in Las Vegas. That's as cheap as it's ever been. It was 35 cents on the dollar in year 2006. Compared to Seattle, it's 26 cents on the dollar. On the income dollar, it was 35 cents. So Seattle hasn't fallen as much, and it won't. It will be a far more stable market than Las Vegas, the Inland Empire, Phoenix, Sacramento, and so on. But it has fallen, and unfortunately, it will fall a bit more during next year as it lags the overall recovery. Here's what the overall job growth looks like. We actually do have some positive news in Seattle, in that we've had positive year-over-year job growth for the past 3 months. Seattle is actually, despite the fact that the housing market is lagging behind, the economy is actually at par with the nation, or even leading the nation a bit in terms of an economic recovery and job growth. This is what our forecast looks like during the next 5 years in Seattle in terms of job growth. That translates into job growth by industry. Right now, as of October 2010, the past 12 months have looked like this, where most of the losses continue in construction, but a fairly broad-based gain throughout many industries in terms of job growth, much better than it looked a year ago. This is what it looked like a year ago. Still significant job losses in most of the industries a year ago. So we've certainly made some progress, and the progress initially has to be made in the economy before it filters to the housing market, and we're in that phase of the cycle where we're doing just that. So to summarize, the Seattle economy is just beginning to recover with year-over-year job growth that began in August of year 2010. Housing construction is at an all-time low. Private builders can't get financing to build homes in Seattle. The housing affordability in Seattle and most other areas throughout the nation is at an all-time high. There's been a severe overcorrection. That doesn't do much now in terms of where the economy is, but as the economy begins to expand at a more rapid rate, that affordability will begin to help the housing market recover. Distressed housing continues in the Seattle market, and it will grow in the near term. It will remain significant probably through 2014. Marginal price appreciation was apparent during the past 12 months. It was just about flat, just about at zero, which is an improvement from where it was a year ago. It will begin marginally in 2011 as economic growth becomes more apparent and undervaluation is increasingly realized in the Seattle market. Transactions have increased year to date, but they've fallen during the most recent months, and overall transactions we think will grow modestly for all of year 2011, despite the fact that they'll continue to fall during the next 3 to 4 months. Market and price stability in year 2011 will be driven by undervaluation as opposed to economic growth. Prices will be stable, but that doesn't mean that they'll appreciate significantly. At best, they'll appreciate at a very marginal rate. And then finally, the mature market, based upon population trends that we see in Seattle, that plays a much more significant role in this next cycle. That is the conclusion of our 15-minute segment YouTube segment for this week. Thank you very much for joining us. We'll hope you join us next week as we cover the national overview of what's going on in the economy nationally, as well as the housing market. And then the week after that, on December 15th, which will be our final webinar of the year, I'm actually going to introduce our new website, something that to me is very exciting. It will blow your socks off. We've spent a lot of time and money on this, a lot of programming dollars. We think that you'll be impressed with what we have to show and introduce on December 15th. Thank you for joining us. Take care.